If you ever plan on retiring, you'll want to know the most common financial mistakes that people make during retirement. These blunders can be disastrous to what would otherwise be a comfortable and rewarding retirement after years of hard work. By noting these blunders long before your retirement date, you can avoid them entirely to ensure your financial security. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Years after work are stress-free and enjoyable. If this video is useful in determining how much to withdraw, you'd be shocked at how many people watch it. People plan for retirement without knowing how much their nest egg will provide an annual income. Instead, they spend as they please, which can be disastrous. A popular rule of thumb is that it's safe to withdraw 4% of your portfolio each year, with annual adjustments for inflation. However, this rule has some flaws. It is highly dependent on what you have invested in your projected retirement length and on past market performance, but use it as a starting point. Just because your investments return 10 on average does not mean this is a wise amount to withdraw, because if you are like most people, there will be times when your returns are negative. People working during retirement is unpleasant at best. Why would you want to go to work and do what you've been trying to avoid for years? No one thinks they'll want to work once they retire. I'll never get bored. I have plenty of hobbies. I'll keep busy, and I definitely won't want to work. Our common thoughts for those who haven't retired. The fact is, boredom is common for retirees who struggle to fill their days. Eventually, daily rounds of golf and afternoon naps get boring. Provide numerous advantages, including structure, socialization, fulfillment, and extra money. Don't dismiss the option totally. Instead, consider what kind of work you would enjoy. Underestimating how long they'll live is difficult to conceive at any age, but the reality is that a healthy person has a very long life. The high likelihood of reaching that milestone can cause you to overspend in the early portion of your retirement. Are you financially prepared to live up until the average life expectancy for older individuals who are healthy? Living past the average life expectancy could cause you to overspend in the earlier portion of your retirement. It can be tempting to begin enjoying your retirement and rewarding yourself with some splurges, but overspending in the early stages of retirement can lead to problems later on. You don't want to reach an age that you thought you'd never reach and regret spending money freely as you celebrate your retirement early on. Spending too little or too much can both be problematic. Not spending enough and enjoying what you've accumulated over your lifetime, while a better situation to be in, isn't ideal either. Before retirement, you had an estimate of how much money you could comfortably spend during retirement, making modifications as time goes on and sticking to it. According to your plan, you should spend money on some of life's finer things. What's the point of living a healthy, long life if you're not going to buy items and experiences that you enjoy? Retiring with a large pile of money but lacking the life experiences you wished you'd had is less than ideal. Accepting Social Security at the wrong time, the amount of money you thought would properly fit in your retirement plan. The longer you wait to accept Social Security, the more money you'll receive each month in benefits. But how long should you wait? Should you start at age 62, wait until age 67, or even wait until age 70? It's tempting to claim benefits as soon as possible, but there are some factors to consider. Do you plan on earning money before reaching full retirement age, which is 67 for most people? In 2024, an individual can earn nearly $20,000 per year without having their benefits lowered. Every $2 you earn beyond this level reduces your benefit by $1. On the other side, if you wait until age 70 and only live to be 72, you will receive very little money. There are numerous variables when it comes to the ideal time to claim benefits, so make sure to examine your situation. One of the most significant issues with debt is that the monthly loan payments significantly increase the amount of income required throughout retirement. Just having $300 in monthly debt payments can boost the size of your nest egg requirement by $100,000. Add another payment or two and this grows. The amount you need to retire significantly could have a serious impact even for someone who is a multimillionaire. Generally, it's best to retire with no personal debt like a car payment, mortgage, or any other loans. Not enough cash in terms of retirement, you'll be able to access your retirement funds that you previously couldn't without incurring big fines once you're old enough. But having money set aside for unexpected events is a good idea and will put your mind at ease. Saving money in a savings account will prevent you from having to disrupt your retirement plan due to unforeseen isolated circumstances. Furthermore, if the financial markets crash 30 or 40% next week, these savings will provide an extra cushion, allowing you to withdraw from this account first in order to give your portfolio time to recover without accounting for taxes, which will vary depending on the type of accounts and investments you have. Income from a traditional IRA or 401k is subject to ordinary income tax rates, which means you'll face taxes during retirement. On the other hand, income from a Roth IRA or Roth 401k isn't subject to any additional taxes because you already paid them when you made the contributions. The earnings from a standard brokerage account could be taxed in a variety of ways, including as regular income and capital gains. Knowing what tax band you'll be in throughout retirement will help you forecast how much you'll owe, which will be a big influence in calculating a safe amount you can spend with all of the changing parts. Parts of the tax code contemplate hiring a CPA who can assist you with your unique circumstances. Housing bills can be expensive for retirees if they are hesitant to change their home to meet their needs. It makes no sense to keep a home with high property taxes, insurance, and utilities if a smaller, less expensive home will be a better fit for your budget and lifestyle. If staying current with household chores and maintenance tasks becomes increasingly difficult for your lifestyle, you may need to hire someone to perform these duties, adding to the expense of having a large home, or worse. If these tasks aren't done, it may reduce the value of your investment. Spending less time and money on homeownership allows you to make better investments. You should allocate those dollars to other activities that are better suited for retirement, without regard for replacement expenses. What objects you own that are of substantial worth will need to be replaced at some point in time. These include expensive products that you will need to plan for even if you do not intend to use debt to pay for them. Such replacements must still be budgeted for. One of the most common examples of this is a car that is owned outright. You may own it free and clear, but do you truly expect it to last the rest of your life? If you're 65 years old and driving a 5-year-old paid-off vehicle, the chances of that happening are slim. Whether you plan on semi-retiring and working forever or retiring early and never working another day in your life, you want to make the most of the time you worked hard for by avoiding some of these extremely common mistakes people make during retirement that can significantly improve the quality of your retirement. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?